Here's a sobering truth. 90% of beginner investors never look at a company's balance sheet before buying stock. They chase prices, follow trends, and wonder why they lose money. Meanwhile, Warren Buffett, worth over $100 billion, spends most of his time reading balance sheets. Why? Because that's where the real truth lives. And by the end of this video, you'll know exactly what he's looking for. Imagine buying a stock at $50 because it was trending, only to watch it collapse to $5 when the company revealed massive hidden debt. This happens every single day, and it's completely avoidable if you know how to read one simple document. Let's start with the basics. A balance sheet is like a financial snapshot of a company at a specific moment in time. Think of it as a detailed X-ray that shows you three critical things. First, assets. Everything the company owns. This includes cash in the bank, buildings, equipment, inventory, intellectual property, and money owed to them by customers. Assets are the resources the company uses to generate revenue. Second, liabilities. Everything the company owes. This means loans, bonds, unpaid bills to suppliers, employee salaries due, and any other debts. Liabilities represent claims against the company's assets. Third, equity, also called shareholders' equity or net worth. This is what's left for the owners after you subtract all liabilities from all assets. It's the real value that belongs to shareholders like you. Here's the fundamental equation that never changes. Assets equal liabilities plus equity. If a company has $100 million in assets and $40 million in liabilities, the equity is $60 million. That's the cushion protecting shareholders. Think of it like buying a house. If your house is worth $300,000 and you owe $200,000 on the mortgage, your equity is $100,000. Same concept, bigger numbers. Now, you might be wondering, why focus on the balance sheet? Can't I just look at revenue and profit? Here's the problem. Income statements show you what happened during a period, last quarter, last year. They can be manipulated with accounting tricks, one-time sales, or aggressive revenue recognition. Companies can look profitable on paper while drowning in debt. What the balance sheet shows. The balance sheet shows you the accumulated reality of everything the company has done. It's harder to fake because it represents actual assets you can touch, actual debts you must pay, and actual value that's been built over time. This document answers the critical questions. Does this company own valuable assets that generate cash? How much debt are they carrying, and can they handle it? Is the business actually building wealth or just borrowing to survive? If everything went wrong tomorrow, would shareholders get anything? Real financial risk lives on the balance sheet. A company can report growing revenue while simultaneously taking on crushing debt. The income statement looks good, but the balance sheet screams danger. This is why sophisticated investors, the ones who actually build wealth, always start with the balance sheet. It's the foundation of intelligent investing. Warren Buffett learned his investment philosophy from Benjamin Graham, the father of value investing. Graham taught him one core principle: don't buy stocks, buy businesses. And when you buy a business, you need to understand what you're actually buying. Graham's approach was simple but powerful. Look at what the company owns: factories, inventory, cash, receivables. Subtract what it owes. If you can buy the stock for less than that net value, you have a margin of safety. You're buying $1 for 50 cents. Buffett evolved this approach. He doesn't just look for cheap assets. He looks for exceptional businesses with competitive advantages, what he calls moats, that can compound value over decades. When Buffett analyzes a balance sheet, he's looking for specific characteristics. 1. Productive assets. Does the company own assets that generate cash and competitive advantages? Coca-Cola's brand, See's Candy's customer loyalty, BNSF Railway's rail network. These are productive assets that create lasting value. 2. Minimal debt. Buffett prefers companies with little or no debt. Why? Because debt creates risk and limits flexibility. During tough times, debt-free companies can survive, invest, and buy competitors. Heavily leveraged companies go bankrupt. 3. Growing equity. He wants to see shareholders' equity increasing year after year. This means the business is retaining earnings and building real wealth, not just borrowing money to look good. 4. Strong cash position. Companies with substantial cash and marketable securities have options. They can weather storms, make acquisitions, and return money to shareholders. Cash is optionality. Owner mentality, not speculator. Here's what separates Buffett from gamblers. When he looks at a balance sheet, he's asking, if I bought this entire company today, would I be happy owning these assets and these liabilities? Would this business make me wealthier in 10 years? He's not asking, will this stock go up tomorrow? That's speculation. He's thinking like an owner, not a bettor. Let's get practical. What specific numbers should you look at on a balance sheet? Here are the key indicators that matter. 1. Return on equity, RO. ROE tells you how efficiently the company generates profit from shareholders' equity. If a company has $100 million in equity and generates $15 million in profit, that's a 15% ROE. Buffett loves companies with consistently high ROE, 15% or above, because it means the business is compounding wealth efficiently. Think of it as your return if you own the entire company. But here's the catch. Make sure that high ROE isn't coming from excessive debt. Some companies boost ROE by borrowing heavily, which increases risk. 2. Equity growth over time. Pull up the last 10 years of balance sheets. Is shareholders' equity growing consistently? This indicates the company is retaining earnings and building intrinsic value. If equity is stagnant or shrinking, ask why. Is the company paying out all profits as dividends? Buying back stock? Or worse, losing money, destroying value? 3. Debt analysis. Sustainable versus dangerous. Not all debt is bad, but you need to understand the difference between sustainable debt and dangerous debt. Look at the debt-to-equity ratio. If a company has $50 million in equity and $25 million in debt, that's a 0.5 ratio. Manageable. If they have $50 million in equity and $200 million in debt, that's a 4.0 ratio. Dangerous. Also check, can the company pay its debt with operating cash flow? Look at interest coverage. How many times can earnings cover interest payments? If it's less than 3x, that's a red flag. 4. Current ratio, short-term health. The current ratio tells you if the company can pay its bills over the next year. You want this above 1.5. Below 1.0 means they might struggle to pay suppliers, employees, and short-term debts. 5. The economic moat on the balance sheet. Buffett's famous moat concept shows up on the balance sheet. Look for strong brand value, intangible assets, proprietary technology, patents, intellectual property, network effects, customer data, platform ecosystems, physical infrastructure that's hard to replicate, railways, pipelines. These assets create competitive advantages that protect profit margins and allow the company to raise prices over time. Let's make this concrete with 2 hypothetical examples. Example 1. Healthy balance sheet company. Meet Company A, a consumer goods business with strong brands. Total assets, $500 million. Cash, $80 million. Inventory, $120 million. Property and equipment, $200 million. Brand value and IP, $100 million. Total liabilities, $150 million. Short-term debt, $20 million. Long-term debt, $80 million. Accounts payable, $50 million. Shareholders' equity, $350 million. Let's analyze this. The debt-to-equity ratio is 0.43, very healthy. They have $80 million in cash against $100 million in total debt, so they're nearly debt-free in net terms. Current ratio is strong, and over the past 10 years, equity has grown from $200 million to $350 million. That's 75% growth from retained earnings. This company owns valuable productive assets, manages debt conservatively, and builds wealth over time. This is what Buffett looks for. Example 2. Risky balance sheet company. Now meet Company B, a high-growth tech startup everyone's talking about. Total assets, $400 million. Cash, $30 million. Equipment, $50 million. Goodwill from acquisitions, $250 million. Other intangibles, $70 million. Total liabilities, $380 million. Short-term debt, $80 million. Long-term debt, $250 million. Deferred revenue, $50 million. Shareholders' equity, $20 million. Red flags everywhere. The debt-to-equity ratio is over 16 times, extremely dangerous. Most of their assets are goodwill from acquisitions, which is accounting fluff that can evaporate. They have $80 million in short-term debt, but only $30 million in cash. This company is one bad quarter away from serious trouble. The company is growing through debt-funded acquisitions, not through real sustainable profits. Equity is razor-thin, just 5% of assets. This is the kind of company that can be trading at $100 per share on hype, then collapse to $10 when reality hits. The key difference. Company A built wealth through operations and retained earnings. Company B manufactured growth through debt and acquisitions. The stock charts might look similar for a while, but the balance sheets tell completely different stories. Buffett would never touch Company B, no matter how exciting the story. He'd study Company A, wait for a reasonable price, and hold for decades. Let's talk about the mistakes that cost people money. Mistakes you can avoid by understanding balance sheets. Mistake number 1. Ignoring shareholders' equity. Most beginners look at revenue growth and stock price movement. They never check if the company is actually building equity. You can have growing revenue and shrinking equity. That means the business is destroying value while looking successful. Always ask, is shareholders' equity growing? That's your piece of the pie. Mistake number 2. Focusing only on stock price. Stock prices can rise for irrational reasons. Hype, momentum, speculation. But eventually, fundamentals matter. Companies with terrible balance sheets can have rising stock prices for months or even years, but they always eventually crash. Price is what you pay. Value is what you get. Learn the difference. Mistake number 3. Confusing marketing with real value. Great marketing can make any company look innovative and disruptive, but marketing doesn't appear on the balance sheet. Real assets, real cash flow, and real equity do. Don't invest in stories. Invest in businesses with tangible value. Mistake number 4. Buying leveraged companies, hoping for miracles. Some investors intentionally buy highly leveraged companies thinking, if they succeed, the stock will explode. That's gambling, not investing. Yes, sometimes it works, but most of the time, excessive debt destroys shareholder value. When things go wrong, and they always eventually do, debt magnifies losses. Equity holders get wiped out while creditors take over. Buffett avoids this entirely. He only invests in companies that can survive worst-case scenarios. Let's bring this together. The balance sheet is the foundation of intelligent investing. It shows you what's real, the assets the company actually owns, the debts they actually owe, and the equity that actually belongs to shareholders. Warren Buffett became one of the world's wealthiest investors, not by chasing trends or timing markets, but by deeply understanding businesses through their balance sheets. He thinks like an owner, not a speculator. He buys real value, not stories. You can do the same thing. It doesn't require genius or special access. It requires patience, discipline, and the willingness to read financial statements before clicking buy. Your action steps. Here's what I want you to do. 1. Pick a company you're interested in, any public company. 2. Go to their investor relations website and download the latest annual report. 3. Find the balance sheet. It's usually right after the income statement. 4. Look at the 3 sections: assets, liabilities, equity. 5. Calculate the debt-to-equity ratio. 6. Check if equity has grown over the past 5 to 10 years. 7. Ask yourself, would I want to own these assets and these liabilities? Do this exercise once, and you'll immediately understand businesses better than 90% of retail investors. If this video helped you understand balance sheets and value investing, hit that like button and subscribe to this channel. We're building a community of people who invest intelligently, not emotionally. Drop a comment below telling me, what company are you going to analyze first? I read every comment and use your feedback for future videos. Remember, the more you learn, the more you earn. Keep studying, stay disciplined, and invest like an owner. I'm Murilo, and I'll see you in the next video. Important reminder, this content is for educational purposes only and is not financial advice. Always consult with a licensed financial professional before making any investment decisions. Past performance does not guarantee future results.